Hello, this is Mike Swanson of Wall Street Window. I got a very special guest with me today. I'm speaking with David Skarica, who runs the website addictedtoprofits.net. How you doing, Dave?
Good, Mike. Good to be here.
Well, we haven't spoken, I think, since October. So, a lot's been going on. We've seen this explosion in Bitcoin. Gold has gone sideways, but it went up a little bit following the Fed meeting, and the stock market's doing what it's doing. So just like to get your take on what you think's going on. What do you think is happening, for instance, with gold right now?
Well, with gold, I've kind of been quiet on it because you have the seasonal trade in gold where often you go higher into the summer and then you kind of will lag or even decline into right about now, just between like October and December period. So a lot of the times too, the big moves, if you go look at like 2016 when there was a rally in the first quarter in gold, or even first quarter of 2017, and then late 2015 when gold really rallied the first half of 2016, you almost get these bottoms in early to mid December, and then this move higher. So that kind of looks what's setting up to me here right now. That we're going to get this kind of bottom here. We saw a good move around the Fed meeting, and we could move higher. And really another thing about gold, the way it traded from most of 2017 was really unique in that it has been a very tight trading range, and the gold stocks tend to be about the most volatile stocks in the world. So for them to trade in this tight of a range right now is really, really rare. And actually another point that should be made is if you go look at the 2000-2008 period, when the gold stocks really had a huge run with only small consolidations and corrections, this is how these corrections usually played out, that you would get a 12 to 18 month sideways movement after a big move higher, and then you would kind of break out to the upside. And if you go look at August, August of 2016 when the last top was in the gold stocks, well, about February would be your 18 month consolidation. And my opinion is that the new Fed Chair Powell is going to be very dovish. Part of the reason he's been put in is just to try to keep the stock market bubble going into the next election so Trump can get himself reelected. And that means more dovishness. And also the dovishness makes sense from just where the bonds are trading. You got about 1.25%, 1.5% of the Fed funds rate, and you're at 2.30 on the 10-year bond, and the 2-year bond is 1.80. So you're getting a very, very flattening yield curve. And if they were to raise rates 3 or 4 more times, you'd have an inverted yield curve, which tend to happen before bear markets and recessions. And actually, that's what did happen in 2006, for example.
Yeah, I feel the same way as you do with gold. That it's like those consolidation ranges of from 2000 2006. I remember them very well because back then I would try to trade gold with a 100% position and jump in and out. And when it was in those ranges, it's very difficult because when it gets to the top of range, it's easy to get bullish and think, oh, the breakout's coming. And then if you put a tight stop on it and it doesn't break out, you get stopped out and so forth. And now I see the same thing happening to people, or if they're trying to trade big positions, it's tough. And then also when it does kind of come back down to support, which it did recently, then a lot of people get scared and they sell out or they think it's going to crash. And then it turns around. So I think it's easier just to figure out a strategy to be able to hold so you can withstand these moves up and down, and then you'll be in it when it eventually does turn up.
Well, the simplest strategy is just to do an asset allocation. So say have whatever you're comfortable with, 5, 10, 20% of your portfolio in gold and gold stocks, and that way when they go down, like let's say gold stocks went down 20%. The rest of your portfolio did nothing. Let's say you're 20% invested. Well, then gold stocks would go down to being 16% of your portfolio. So then you could add that 4%, basically add the gold stocks by 25%. And the same thing when they go up, the gold stocks go up 100% and they can rally like that when these big rallies happen. Well, then they could be potentially 40% of your portfolio and you might want to half the exposure to keep it at 20%. So that's really a unique way of doing it. And let's face it, because the stock market bubble has gone so much further than higher than most people expected, having an asset allocation model would have been the best thing to do for the past 5 years, because you would have been you'd be slowly selling off stocks. They've had this huge rally in the last 5 years, and you'd be slowly accumulating in gold. And and you probably would have underperformed the stock market, but you still would have been having pretty good gains every year. And by the way, also by doing that model, you tend to get in at higher positions at bottom. So using that model, when gold stocks topped in 2011, 2012, you would have been reducing your positions, and then when they really crashed in 2013 or late 2016, you would have been increasing positions. So I think that's really, really the way to handle it. And another way I do it as well is I have these like junior mining stocks that are well funded. Most of them either usually have resources or they're small production or nearing productions. And those stocks are the ones that are the most leveraged when the price of gold turns higher. So you were talking about 20% asset allocation. So out of my 20% or whatever it may be, I'm not just going to own Newmont and Barrick and these names. I'm going to own a lot of these smaller companies that I think are more leveraged when the gold price goes higher. Like if gold goes back to the highs of 2011 at some point, these stocks aren't just going to go up 3 or 4 times. A lot of these stocks might go up 5, 10, 20, even 20 times in value. And that's happened before. For example, in 2009 on our list, we recommended a stock called Avion Resources, which had a mine in Africa, in Mali, this country in Africa. And it was perfect timing. They were going into production right at the same time the gold market turned around in 2009 after the financial crisis. And the stock went from 6 cents to $2 and eventually was taken out at 90 cents by a larger company. But that's the kind of thing that can happen in these smaller juniors that are beginning production or increasing resources. So that's another way to allocate yourself too. But you really have to know the companies, and you have to know the companies that are well funded, that maybe have an asset, maybe have a small producing mine, or about to go into production. You can't just like throw a dart at a board of all these junior companies, because some of the junior companies maybe won't be able to survive another bad year in the gold market, or some of them might have to dilute like crazy through a financing. So you really want to find the most well-managed one, especially this early on in a potential gold bull market.
Well, right now we're at a very, the thing about this moment where we're doing this interview that's so fascinating is we're seeing a mania, I think, in trading Bitcoin with a lot of people that are actually new to trading. This is like the very first thing they've ever bought in their lives is Bitcoin or cryptocurrency. I've seen a statistic that says that the 50% of Bitcoin trades for the first time are people doing $20 or less. And I'm seeing people on my own personal Facebook in the area I live in that are, becoming traders for the very first time in Bitcoin. And people like that, they may hear what you're saying about asset allocation and think, well, that's for millionaires. I don't have that kind of money. Picking out stocks, that's a lot of work. Why do I want to do that? I want to get rich quick. Bitcoin is going up. There are people on the internet saying if you put $100 into Bitcoin, you can make $1 million. So why should anyone, not just simply do that and try to get rich?
Well, I am setting up a couple trading strategies for cryptocurrencies. Some of it's a little different in that because, we're both stock market guys. So I'm not going to really tend to trade these coins or, these ICOs or the whatnot. Even the problem with trading options or when they come out and the futures is that it's really expensive because of the high volatility nature. And so what you're going to do is if you want to trade options on Bitcoin, you're going to see huge implied volatility. Say in the options, whatever it is, the options on the futures contract or the options on a potential ETF trading. So you're going to see this huge implied volatility and a lot of the premium already priced into the option. Like, for example, one of the stocks I'm looking at as a potential short, I'm doing a long short kind of trading system with the cryptocurrencies. There's 2 stocks that I have that have smaller market caps that have potential to go higher that I'm looking to go long. And then there's 2 or 3 stocks which have, multi-hundreds of millions of dollar market caps. One has near $1 billion market cap, which I'm looking to short. So I'm looking to kind of go long these smaller, maybe more undervalued companies, and then go short these more well-developed companies that have already had big runs, right? So, so I think that's the problem with trading it too. Like Nassim Taleb, the Black Swan author, he basically said you can't really short Bitcoin because there's no options. And again, the problem you're going to get when there are options, even the implied volatility or premium in them is going to be discussing, it's going to be sky high. And the way that, say, Talib, for example, in these crashes has made money, he buys way out of the money put options on things that really don't have a lot of implied volatility. Like, for example, right now, I'll give you one trade. I think Mike's looking at it too, is the junk bonds right now are at sky high valuations. But because the junk bonds have been very stable the last few years, the implied volatility or premium you pay in the options in them to go short them via put options or say calls and say the inverse junk bond ETF is very low. So that's the kind of thing that if you get another kind of crisis, you get another crash, and the junk bonds blow up, you're going to get a lot. You're going to go from having no premium to tons of premium, and that's really how you're going to make money on the downside. So really with Bitcoin, I'm looking more at trading strategies. I still think it has a little ways to go to the upside. Part of the reason is even though it's trading so crazy, and I think it is a bubble. The problem is I see too many people calling it a bubble. Right? You read, if you go on Yahoo Finance, they'll have a lot of articles calling it a bubble, et cetera, et cetera. And my feeling on the final phase of the bubble in cryptocurrencies will be essentially when the ETFs come in. Because when the ETFs come in, that's when it's going to be even an easier way for investors to buy it. They'll pile into them. Those ETFs will then have to turn around and buy the coins. That will give it kind of like one last final pump.
Yeah, there's been that's the other thing that's happened over the past 2 years is really a surge in regular people that already have brokerage accounts that have been investing for years or decades, actually buying ETFs and almost doing that as their primary focus. This first quarter of this year saw the biggest amount of money inflows into ETFs in the history of ETFs, just in the first 3 months. The XLF ETF and SPI were at the top of the list. And Warren Buffett even said that just fire your money manager, don't pay fees, and just put your money in ETFs and forever. And the stock market has done, well this year. It hasn't pulled back once over more than 3%. So people now are fairly convinced that there'll never be a pullback again and kind of risks are eliminated. So do you think that sort of environment can continue next year, or people can just make money nonstop without ever experiencing a pullback again in 2018?
I actually think we're getting into a dangerous territory with this kind of non-volatility market. And by the way, this is why cryptocurrencies are popular among retail investors now and globally. Because even though the stock market's gone up, you look at all the FANG stocks are up huge this year, it's because there's just no volatility in the stock market. We both were around, we both started out in the dotcom era in the late 90s, and we remember these crazy stocks that would go up 40% in a 30% or 10% in a day and down the same amount in a day. And, the cryptocurrencies are more like that. So that's attracting the day traders, right? Because they actually have volatility in these coins where they don't get it in the stock market. You're not getting pullbacks. It's almost like a fake market, the stock market. You've had the central banks pump trillions of dollars into it. You've got massive stock buybacks, which are going to increase now that they're going to repatriate money. You got companies, borrowing money at dirt cheap levels to do stock buybacks, and you've got like these robots, ETFs just buying off moving averages, and until there's a catalyst for somebody to sell, it probably will keep up like this in the short to intermediate term. But I'm always brought back to something that Kyle Bass, who's one of the famous hedge fund managers who made money in the financial crisis, says, is that the average person's mentality is like 2 years. So, for example, in 2009, the market had been going down for almost 2 straight years. Say in March of 2009, the market actually had been going down for almost 20 months, right? Since the summer of 2007 when it topped. And everyone was bearish on the market then, right? Because, it had done nothing but essentially go down for 2 years. All they thought it could do is go down. Every rally was a selling opportunity. No one thought a new bull market could start, et cetera, et cetera. Well, now, not only are we 8 years into this bull market, but we're almost 2 years into the market since the bottom of that correction in February 2016, where the market hasn't even seen, a 4 or 5% correction. So people now really think it can't go down. It can't even have corrections. So that's very dangerous territory. And you're seeing guys, like another famous hedge fund manager who made money in the financial crisis, John Burbank, just shut down his funds. And we're seeing this where people are moving from active management, meaning long short strategies, hedge funds, into passive management, which means just buying ETFs, just going fully long. And the problem with that is that means that people are going to get more exposed to the long side. And I think that's when you can start getting gapped down in a potential crash scenario at some point where, the people didn't think that these things could fall, and you got everybody on one side of the trade, and they all got to start selling at some point whenever that catalyst comes. Now, you got to be honest about it. Typically, that catalyst or those crashes don't happen until the fall. Sometimes you get them like they happened in the spring of '62. It happened in kind of the April-May period. But for the most part, those kind of big precipitous declines don't happen until the fall. So you would think, especially with the amount of money that's going to come in for stock buybacks and increased dividends and M&A due to the repatriation of funds, over the first half of the year, that may be able to hold up the market. But then I would definitely look for some kind of catalyst the second half of next year. And I don't know if that catalyst is maybe China's debt bubble, like Kyle Bass has been predicting, blows up. Maybe we get a mini return of inflation when the Fed takes a much more dovish stance, over the first half of next year. I don't know what it is, but I do think something will happen. And look, and everyone's just going to roll your eyes at you if you say that now, right? They're going to roll your eyes at you that, there's no crash coming, there's no correction coming, look at the way market's done, but, that's just kind of the nature of these things, right, with psychology.
Well, I know people that are fully invested in the stock market, if you talk about a crash or a potential drop, they're not going to listen, or they can actually get very angry. However, I got to say that over the past couple of weeks, the people I've been watching on Facebook that are getting into Bitcoin and really trading for the very first time, they actually say they think the stock market can crash, and they almost want it to happen. Because they argue that Bitcoin will go up and benefit from a stock market crash. They believe it's a safe haven and actually liberate us from central banks. So what do you think of that argument? Just buy Bitcoin,
Okay. In 2015, I was very apprehensive about Bitcoin at first, but I started to kind of read a little bit more about it about 2 to 3 years ago, and about the blockchain technology and the way it was set up where, only a certain number of coins are issued. So actually, and then when Bitcoin kind of fell with gold in 2014 and 2015, I was like, you know what? Bitcoin might be an alternative currency. And I actually wrote a couple of times saying, you might look in, on these corrections of buying both gold and Bitcoin. Now, unfortunately, all I did was buy gold and gold stocks, right? And I didn't buy Bitcoins, but then it was $150 or $200 a coin. And now it's, it's 19,000. But now I do not think that anymore. Now I really believe it is just an extension of the stock market bubble that, we always have, we have dotcom, we have housing. Remember, a housing bubble is really interesting because the stock market, even though it was in a bull market then, was not really blowing off, but an extension of the cheap money and a bubble that went on in the mid-2000s was these housing prices going up like crazy. Now this time the stock market is a bubble in terms of the valuations, but, I think the real extension of that is in these cryptocurrencies and in Bitcoin and the whatnot. And you can say it's going to $1 million or whatever the hell, but look, I tend to believe in that very simple technical belief that all parabolic curves collapse. And you go look at Bitcoin, you look at the NASDAQ in 2000, you look at tulip bulbs, you look at the South Sea bubble, you look at 1929, you look at any great bubble in history, Bitcoin is trading exactly like the rest of those bubbles with this huge kind of parabolic increase going on in it. So I think that, no, Bitcoin will not go up in a crash. It will crash with the stock market. And it should be noted, too, that when the stock market essentially for 2014 and 2015 kind of had a 2-year consolidation, which really lasted into the fall of 2016, Bitcoin really did nothing during that time period as well. It consolidated itself and then kind of broke out like crazy. So actually, Bitcoin has not been trading counter the stock market at all. Again, I feel it's a reflection of the stock market's bubble,
Well, the only thing I'd say about that is, most of the people that trade Bitcoin, they're doing it on their phone, and they look at the price quote every day, and that's basically what they look at. They don't look at these charts. They don't really know what the tulip mania and all these other things you talk about are. So maybe these people, if they don't know these kind of risks and chances, maybe they won't sell.
Well, there's one interesting thing, too, and which reminds me of the dot-com bubble with Bitcoin. Well, there's two things. Number one, the underlying technology, just like the internet, was something that was going to change our life. Like the blockchain technology is going to be a new way to store information, to send money, etc. Now, the problem is, I think that regular companies are going to adopt this technology and make these coins basically worthless. I think that's the big problem, right? That if you want to send money easy or do billing easy, well, why? Visa's going to do it. Your bank's going to do it, right? So, and they're going to wipe out a lot of these little coins, right? And then these little coins become, because they're currencies. That's what they call cryptocurrencies. Well, the currency of Venezuela is worth nothing because they've hyperinflated, and the economy essentially is worth nothing right now. Well, if all of a sudden these technologies are adopted by larger, more mainstream companies, well, those currencies become worthless, right? So, and number two, it's like all people do with these coins is talk about price action. Like I watch a couple of these guys who do these podcasts and video casts on YouTube talking about Bitcoin and the other, trading. And what's the funny thing is they never talk about, even if you're a technical trader, you're going to why are you going to be, say, buy Amgen? Because, you want to find a company that's in the healthcare space or pharmaceutical space or, biotech space, right? And you know what it does, it produces drugs, blah, blah, blah. So even though you're trading it technically, you still have some fundamental base of what industry the company's in. And these things, all these guys do is talk about price action. Like if they're talking about Ripple or Ethereum or Litecoin or Cardano. Cardano, by the way, is up 72% today. This is another one. It's got a $13 billion market cap, right? And it's like, or Dash, they don't ever talk, what the fuck, excuse my language, but what the hell do these things do? They don't even really talk about it. And here's the last thing that's interesting about the blockchain technology. It's estimated that last year, about $250 million of business was done in the blockchain technology. And that's going to go up tenfold to $2.5 billion in 2021. Okay, well, let's say it goes up, 50-fold, right? To, 100 billion or something like that, right? The problem is, these things are, they don't, 50 will be 20 billion. The problem is, look at the valuations of these things. Bitcoin has a $324 billion valuation. How much business is actually being done with it? Same thing goes for all these other currencies. So you have to understand, I know they're not valued the same way because they have this currency aspect to them, but it's like at some point you have to be valued to what actually underlying business you are doing in these things. And these things, Ripple has a $28 billion valuation, I think Netflix is overvalued, but at least I know what the hell Netflix does. And Netflix has a $60 billion, valuation. So I think that's another sign to me that it's a bubble. That people, by the way, thought this, you could do this with the dot-coms too, because a lot of those dot-com companies didn't have revenues or business plans or whatever. They thought they could just trade these things on price action and technical analysis. And in the end, they could, and everything just blew up. And I think that's what's going to happen in a lot of these coins. And the last point is, even if you really believe in the technology, 99% of these coins are frauds, and excuse my language, bullshit, and they're going to go under. It's just like the first dot-com boom, right? And even a guy like James Altucher, who is like a bull in all this, he even says this, right? That if you go look at that first boom in technology and in internet stocks, what's still around? AOL survived, Yahoo survived, obviously, Amazon's done very well, Priceline, eBay. There's like a handful of companies that traded in the late 90s that still exist now. The rest of them all went under, or even if they did get taken over, like CMGI got taken over, they were at a fraction of their all-time highs when they got taken over. So that's the same kind of thing with this, is that only a handful of these things are even going to survive, and maybe a lot of the leaders in this kind of blockchain technology going forward are companies that don't even exist yet. You know, like Google it existed, but it didn't IPO until after the dot-com bust. So that's another thing too, is that most of these things that you're trading probably won't even exist in 3 to 5 years.
Well, I just saw a story. It said AOL Instant Messenger has been deactivated, and that was such a big thing in the 90s for a couple of years. You know, it was like the Facebook of the time. Well, as we wrap up, can you tell people what it is you're looking at now to actually make money in, and how they can get more information from you?
Okay, so what I'm doing is we're picking away at some of these small gold companies. Actually, if you go to my website, I just put it up. I did an interview with a company called Mexican Gold, who's one of my corporate subscribers, and my family owns some shares in this company. And this is a company that just had some two sets of really good drill results in the last month. They're building on a 1 million ounce deposit in Mexico. So buying stuff like that, that's building ounces or getting towards production, which I think can take off when gold and silver prices really take off. Or, you know, we're now I do have a bit of this crypto strategy, if you're interested in that, where, you know, we got these two smaller companies I'm just recommending as longs, a couple of these larger companies that I'm going to recommend as shorts. And on top of that, a friend of mine is setting up like a crypto website, where, you know, he will get you into, if you're interested, into some of these ICOs. And also, not only that, if you want to learn about it, this website's going to have a lot of education on like what exactly the blockchain technology is and all this sort of thing. So this is kind of what we're doing at the moment. And then me and you know, we also, if people are interested, and if you're an accredited investor, we also buy a lot of these deals. So actually next year, Mike and I are going to have a lot of these deals coming out trading that we bought, you know, in pre-IPO private placements. So I also do that as well. And then I actually buy put options to hedge any long positions that I have.
Well, great. And thanks for taking the time to talk to me and everyone else. Have a Merry Christmas and a Happy Holiday and all that. And we'll talk again soon.
Yeah. Thank you very much.